Hi, I'm Chi from Advantage Lending Group. If you're thinking about buying your first home, one of the biggest questions you might have is, am I actually ready to buy? That's what this masterclass is designed to help you work out. Now, buying your first home can feel very confusing, especially when you're trying to understand deposits, borrowing capacity, government schemes, and all other costs involved. So I wanted to make this a very calm and a practical guide to help you understand the process. Look, there's no hype, no guesswork. We're simply going to walk you through the important things you need to know step by step. The idea is to help you get a clear picture before you buy. We want to understand where you are today, what your options are, and what your next steps might be. And most importantly, this goal isn't to push you into buying a home today, it's just simply to make you more informed and to help you make more confident decisions. So let's get started. One of the reasons why first home buyers often feel stuck as well is not because there's not enough information. It's actually quite the opposite. There's too much information available. You can easily do a search online, watch videos, speak to friends and family, and very quickly you end up overwhelmed. Then you have the conflicting advice. See, one person might tell you to buy right now, someone else says just wait a bit longer, and then there's someone else who might give you a completely different story. Now, there's also an affordability pressure at the moment. Prices have been rising quite dramatically over the last few years. Interest rates are going up. So, saving for a deposit and the cost of living can all make buying a home feel that much harder than it actually needs to be. And finally, there's a fear of making the wrong decision. Now, that's totally understandable being a first home buyer. For most people, buying a home is one of the biggest financial decisions that you'll ever make. So, it's completely normal to want to get it right. But the key point is this: preparation matters more than prediction. You don't need to perfectly predict property prices or interest rates. You need to understand your own financial position, your borrowing capacity options, as well as what you can comfortably afford. And that's what we're going to explore today to hopefully make things a lot easier for you. So, to make this easier, we use what we call the ALG First Home Buyer Map. It's one simple framework that takes you through the entire buying process. At the center is your overall first home buying plan. And around that, there are five key areas we need to work through. So, first and foremost, your goal. What are you actually trying to buy? Where do you want to buy? And why? Then we will look at the numbers: your income, your expenses, savings, existing debts, your borrowing capacity, and how much cash you may need. From there, we will work out your pathway. So, in other words, what steps do you need to take from where you are today to being ready to buy? Then we will look at your team, and that may include your broker, your solicitor or conveyancer, a buyer's agent, your accountant, and other professionals who may be involved in the process. And finally, we look at the actual steps, the correct order of everything from getting yourself prepared through to making an offer, finance approval, and eventual settlement. And lastly, the idea is very simple. Get clear before you buy. Once you understand your goal, the numbers, the pathway, the team and the process, buying your first home becomes a lot easier to navigate. The first thing we need to understand is your goal because the right finance strategy depends on what you're actually trying to achieve. Are you buying a home to live in? Well, that sounds obvious, but it matters because your strategy should be built around your actual needs. We will then look at the location and lifestyle. Now, where do you want to live? Do you want to be close to work? Or do you have a family close by? Or does it need to be a particular school where you want to send your kids to? Or do you want to be close to a train station? Now, then there's a type of property. There's different types of properties that you can look at, whether it's an apartment, townhouse, house, or maybe something that you can grow over time. Now we look at your time frame. Are you hoping to buy in the next month? Or is it something that you're preparing for to purchase in the next year or maybe even the next 2 years? And finally, how long does this property need to suit you? Is it a stepping stone for a few years or are you looking for somewhere you can stay much longer? Because ultimately, your goal is going to determine your strategy. Once we know what you're actually trying to achieve, we can start building the numbers and the finance strategy around that. Once you understand your goal, the next step is to understand your true financial position. We start with a simple snapshot of your household as it stands today. So first, we will look at your income. That might include your salary, wages, overtime, bonuses, or business income. We will then look at your expenses, things like your housing cost, food, transportation, subscriptions, and your normal day-to-day spending. Next is your savings and your assets. That could include your cash, shares, or any other property you already own. We will then look at your liabilities. That includes things such as credit cards, personal loans, help debt, and any existing mortgages. We also need to understand any of your dependents and any ongoing commitments because family responsibilities can also affect your overall financial position. We put all that together, we make a clearer picture of two important things: your cash flow and your net wealth. Now, the key takeaway is that know the numbers before choosing your pathway because once we understand where you are financially today, we can start working out what options you actually make sense for you. Now that we understand your financial position, the next thing is to understand how lenders will assess you. And this is important because not every lender will assess you the same way. First, they will look at your income and how stable it is. For example, whether you're earning PAYG, self-employed, earning overtime, bonuses, or any other types of income. Then they will look at your existing debts and credit limits. Now, this can include credit cards, car loans, personal loans, and any other commitments that you have. They'll also look at your living expenses and the number of dependents that you have, because these will affect how much of your income is available to repay the loan. Then there's your credit conduct and account history. In simple terms, how you've managed your financial commitments in the past. And finally, each lender has its own assessment rate and lending policy. Now, this is where the outcome can vary quite significantly between lenders. The key point is the same buyer can have a different lender outcome. Getting declined by one lender or receiving a certain borrowing limit does not necessarily mean that every lender will reach the same result. That is why we have to choose the right lender for your circumstances. This is one of the most important things to understand, that your borrowing capacity is not necessarily your budget. A lender might be willing to approve a certain amount, but that doesn't automatically mean that you should borrow that much. From the lender's point of view, they're asking, does this loan meet our lending policy? They'll look at your income, your debts, living expenses, their assessment rate, and their own credit policy. But from your point of view, the question is different. You need to ask, does this repayment actually fit my life? That means thinking about your future plans, keeping an emergency buffer, your comfort level, and the lifestyle you want to enjoy. So the goal shouldn't always be about borrowing the maximum amount available. The goal is to really find a loan amount and purchase price that you can manage comfortably, both now and into the future. Because the maximum approval does not equal a comfortable budget. And getting that balance right is a big part of buying your first home with confidence. Once we've worked out a comfortable budget, the next step is going to stress test the repayments because a loan shouldn't only work in the best case scenario. So when you buy a home, the mortgage repayments are obviously one of the biggest ongoing costs, but you also need to allow for the other cost of owning the property. So these are things such as council rates, strata if applicable, insurance premiums, maintenance, as well as repairs. Then you still have your normal living expenses. So you still have your food, your transportation costs, utility bills, and everything else your household already needs to pay for. Now, you ideally want to maintain an emergency buffer as well. So if something unexpected happens, you're not immediately under financial pressure. So for example, you've got to ask yourself the question, what if interest rates start to increase and your repayments rise? Or what if your household expenses now have an increase in childcare costs? Or what if part of your income changes? For example, you're currently relying on overtime to make the repayments, but what if that starts to reduce or even cease altogether? Now, what happens if your property suddenly has major repair that's required? These are the type of scenarios we want you to think about before you commit to the purchase, because if the numbers still feel manageable when you put some pressure on them, that gives you much stronger of a financial position. So the key point again here is that if your purchase only works when every assumption is perfect, the budget may be too aggressive. So the aim isn't just to get into the property, but it's also to be able to comfortably stay there as well. Once you understand your borrowing capacity and your comfortable budget, the next question is how much cash do you actually need to buy? Because your deposit is only one part of the total amount that's required. The first part is obvious, your deposit. Now, that's the amount that you're contributing towards the purchase price. But then there may be transfer duty. Now, this depends on the property, your circumstances, and there might be concessions that are applicable. You may also need to allow for legal and conveyancing costs, and these are essentially the cost of having someone else to review the contract and handle all the legal side of the purchase. Depending on the property, you may also need to budget for things like building pest or strata reports. There can also be a lender and settlement cost associated with completing the purchase. You should also think about moving and setup costs because things like removalers, furniture, utilities, or any other expenses that come with moving into the property. And ideally, you don't want to use every dollar you have just to go through to settlement. You also want to make sure that you have enough for a post-settlement buffer just in case unexpected costs arise. So when we talk about how much cash you need, we're not just talking about the deposit alone. We're also looking at the total amount required so you can settle, move in, and still be financially stable after you have purchased your property. One of the most questions first home buyers ask is how much deposit should I actually put in? And while 20% is often talked about, it's really a benchmark, not a rule that suits everybody. A larger deposit can have some clear benefits. It means a smaller loan, lower repayments, and it may also help you avoid lenders' mortgage insurance. But there can be a trade-off. If you use most of your savings for the deposit, you may be left with a very little cash after settlement. On the other hand, a smaller deposit means you may need a larger loan and your repayments may be higher. It may also involve lenders' mortgage insurance or potentially using eligible government schemes. But it can allow you to keep more cash available as a financial buffer. So the question isn't simply what is the biggest deposit I can put in? The better question is what deposit allows me to buy the property while still remaining financially comfortable afterwards? Because ultimately, the right deposit is the one that supports a sustainable purchase. Once we understand your goal, the budget, and your time frame, the next thing to understand is that there isn't always just one way to buy your first home. Different problems can require different solutions. The starting point is being prepared for a first home buyer. That means understanding what you want to achieve, what you can comfortably afford, and when you would like to buy. One possible pathway is the 5% deposit scheme. Now, for an eligible buyer, this may allow you to purchase with a smaller deposit, provided the ongoing repayments and costs are still affordable. Another option may be a limited family guarantee. In some circumstances, family support can help reduce the amount of deposit you need without your family having to fund the whole purchase. Now, another pathway is simply to change the plan. That might mean looking for a different type of property, a different location, or giving yourself more time to save. Sometimes a small change to the plan can make the overall position much stronger. There's also more advanced options called rent vesting. Now, this generally means that you buy a property in an area where the numbers work for you while you continue to rent or you live at home where you prefer to live. The important point is that none of these pathways is automatically the right answer. The best pathway depends on the problem you are actually trying to solve. And whichever pathway you choose, the same principle will apply. It should remain affordable after settlement. Now, the goal isn't simply to find a way into the market, it's to find a pathway that you can comfortably sustain. Another pathway that may help eligible first home buyers get into the market sooner is the Australian Government 5% deposit scheme. The main benefit of the scheme is that it can reduce the deposit hurdle, and instead of needing to save for a much larger deposit, an eligible buyer may be able to purchase with as little as 5%. Here's how the basic structure works. You contribute your 5% deposit. The government then provides the participating lender with a guarantee of up to a further 15% of the property value. The home loan itself can then represent up to 95% of the purchase price. One of the major advantages is that you don't have to pay lender's mortgage insurance, or also known as LMI, under the scheme. Now, that can potentially save you thousands of dollars compared with taking out a similar high LVR loan outside the scheme. But this is the important part. The scheme helps with the deposit requirement. It does not guarantee that your home loan will be approved. You still need to satisfy the lender's normal assessment. That means your income, expenses, existing debts, credit history, and your ability to afford the repayments will still need to be considered. There are also eligibility requirements around the property you purchase and how the property will be occupied. So the scheme won't necessarily apply for every borrower or every property. The key point to remember is this: the scheme can reduce how much you need to save before buying, but it does not reduce the size of the loan you need to repay. So even if you qualify for the scheme, we still want to make sure that the loan is affordable and sustainable for you over the longer term. Another way that may be available is a limited family guarantee. This is where family equity can help close the deposit gap, but it is important to understand that the guarantor is taking on a real risk. In simple terms, a family member's property can provide additional limited guarantee to support the purchase. That additional security helps the buyer to purchase the home, but the buyer will still remain responsible for repaying the loan. Now, one potential benefit is that it may help reduce the amount of deposit that is required or potentially reduce the need for lender's mortgage insurance. But the guarantor is putting part of their own property at risk. So this isn't something that should be treated just as a formality. That's why independent legal advice is essential. The guarantor needs to properly understand what they're actually agreeing to and the risk that they are involved with. And ideally, there should also be a release strategy from the very beginning. So in other words, we should understand how and when the family guarantee may eventually be removed. The principle is the guarantee should solve the security problem, not stretch an unaffordable purchase. If the buyer can't comfortably afford the loan themselves, adding a family guarantee doesn't fix the underlying problem. Sometimes the best solution isn't to borrow more or stretch the budget. It's simply to adjust the plan. And that doesn't necessarily mean giving up on the goal. Sometimes compromise can actually be a smart strategy. The first lever is property type. So for example, instead of a house, maybe a townhouse or an apartment may allow you to enter the market at a lower price point while still meeting most of your needs. The second lever is location. You may be looking at one or two suburbs away that can make a meaningful difference to price and the value without completely changing your lifestyle. Thirdly is the time frame. Waiting can make sense, but only if there's a clear reason and a plan behind it. That might mean building a larger deposit, reducing debt, improving borrowing capacity, or strengthening your overall position. The important point is a different first property can create a safer first step. Your first home doesn't necessarily have to be your forever home. Sometimes the better strategy is just to buy something that works comfortably today and gives you the options for the future. Another option is called rent vesting. The basic idea is simple. Where you live doesn't necessarily have to be where you own. On one side, you might continue renting where the location best suits your lifestyle. That could mean staying close to work, family, close by school where your kids need to go to, or a train station that's nearby. But because you're renting, you don't have the same ownership control over the property you're living in. At the same time, you may purchase an investment property somewhere else where the numbers make more sense for you. But this creates a different set of considerations. The loan structure and ownership costs are different, and there can also be tax and first home buyer implications that need to be checked carefully. So the key point here is rent vesting is an advanced strategy, not a shortcut. It can suit some people, but it needs to be considered as part of your broader financial position and longer term goals. When you're buying your first home, there can be quite a few different people involved in the process. And one thing that's important to understand is that they don't do all the same job. Different professionals are there to help protect different parts of the decision. So rather than relying on one person for everything, you generally have a team around you. At the center of that team is you, the buyer. Ultimately, you're the one who's making the decision and you're coordinating the different professionals involved in the purchase. Your mortgage broker looks after the finance side, That includes understanding your borrowing position, comparing suitable lending options, structuring the loan, obtaining approval, and helping manage the finance process through to settlement. Your solicitor or conveyancer looks after the legal side of the transaction. They can review the contract, explain the legal terms and conditions, conduct the required searches, and help manage the legal process through exchange and settlement. This is particularly important because the contract is a legal document, so you want the appropriate legal professional advising you before you commit. Depending on the type of the property you're purchasing, you may also use a building inspector, pest inspector, or strata inspector. Their role is to help you identify issues with the property that may not be obvious when you inspect it yourself. For an apartment or strata property, they may also include reviewing the strata records and identifying potential issues within the building or owner's corporation. Some buyers may also choose to use a buyer's agent. A buyer's agent works for the buyer and may assist with finding properties, assessing opportunities, negotiating and selling agents, and helping with the overall purchasing process. They are optional, but for some buyers, they provide additional support. And depending on your circumstances, you may also need advice from an accountant or a financial advisor. This becomes more relevant where the purchase interacts with things like tax, ownership structures, investments, or your broader financial position. There's also one important distinction I want to make. The real estate agent selling the property represents the vendor or seller. Their job is to achieve the outcome for their client. That doesn't mean you can't ask them questions or deal with them professionally, but you should understand whose interest they are ultimately representing. So the main point here is that no one professional does every job. Your broker looks after the lending, your solicitor or conveyancer looks after the legal work, inspectors assess the property, and other advisors may become involved where appropriate. The better these people communicate with each other, the smoother the buying process will generally be. Before you seriously start looking for a property, one of the most useful steps is getting the pre-approval. But it's important to understand exactly what a pre-approval is and what it is not. A pre-approval is essentially a lender's conditional assessment of your financial position. It gives you an indication of how much you may be able to borrow, but it is not the same as having the loan formally approved. Now, to obtain the pre-approval, we will generally provide the lender with information about your financial position, and that can include things like your identification, your income documents, your savings, your existing loans, credit cards, and any other debts that you might have. Now, the lender will then assess that information against the lending policy. If the lender is comfortable with the application, they may issue a pre-approval. The main benefit is that it gives you as much more of a realistic working price range when you start looking at properties. So instead of looking at homes first and then trying to work out whether you can afford them, we've already done a lot of the work up front. But do remember this, the pre-approval is still conditional. It is not an unconditional approval, and it is not a guarantee that the lender will ultimately fund the purchase. Once you have found the property and you want to buy it, the lender will then still need to approve the property itself. Now, that can include completing evaluation and making sure the property meets the lending requirements. They may also check that nothing significantly has changed with your financial position since the pre-approval was issued. Once the property and all of those remaining conditions are accepted, that's when we can move towards a formal approval. Now, here's a hot tip. And it's a very important point that a lot of buyers aren't aware of. Not every lender assesses a pre-approval in exactly the same way. Some lenders may complete a full manual assessment of your application before issuing it. Others may rely more heavily on the information entered into the system and automatically generate an indicative pre-approval. So simply having a piece of paper saying pre-approved doesn't necessarily mean that every part of the application has already been checked by a credit assessor. And here's the key message. The way I look at a pre-approval is this. It gives us as much better understanding of your borrowing position and helps us establish a realistic price range before you start making offers. But we still need to make sure that the property is acceptable, your circumstances haven't materially changed, and all of the lender's final conditions have been satisfied. That's why we continue working with you right through from pre-approval to the actual purchase and the formal loan approval. Now, once you understand your borrowing position and your general price range, the next step is learning how to search for property effectively. One of the most important things to remember again is not to rely purely on the asking price. The asking price is simply the price the property is being marketed at. To get a better understanding of value, it helps to look at what similar properties have been actually sold for. Before you start the search, it can help to separate as well your must-haves from your nice-to-haves. Your must-haves might include things like location, number of bedrooms, access to work or school, or particular property types. Nice-to-haves might include things like a renovated kitchen, a larger backyard, an extra living area, or newer finishes. The distinction can be useful because most buyers will eventually need to make some sort of compromise. Another useful approach is to inspect a reasonable number of properties. The more properties you inspect, the easier it becomes to understand the differences between properties at various price levels. You'll start to notice how things like condition, location, land size, layout, and overall quality can influence the price. Over time, this can help you develop much better understanding of the local market and what represents reasonable value. This is where comparable sales becomes particularly important. Rather than looking only at what properties are currently advertised for, look at similar properties that have recently been sold. Ideally, the comparison should be with properties in a similar location, with a similar land size, number of bedrooms, condition, and overall characteristics. No two properties are, of course, exactly the same, but recent comparable sales can provide a much stronger reference point when trying to understand the value. It is also important to understand the particular type of property you're considering. For example, a freestanding house, townhouse, and apartment in the same suburb can have very different characteristics and values. Even within the same property type, things like strata cost, land size, building condition, location within the suburb, and nearby developments can make a difference. So when comparing properties, the comparison should be relevant to the type of property you're actually considering. Pre-approvals are only a ceiling, not a target. So just because someone has been pre-approved for a certain amount, it doesn't mean that they necessarily need to spend all that amount. It's better to think about the pre-approval as a ceiling rather than a target. The purchase price still needs to make sense within the buyer's own budget, lifestyle, and financial priorities. And lastly, try not to become emotionally committed to a property before completing the appropriate due diligence. Buying a home can naturally become very emotional, especially when you find a property that you really like. But emotions shouldn't replace the research. Understand the property, understand the recent sales evidence, and understand what you're actually buying before you make a decision. Before committing to a property, there are a number of checks that should be considered. This means looking beyond how the property presents and taking the time to review both the contract and the property itself. The aim is to identify any issues that could affect the purchase before becoming legally committed. Due diligence can involve several different checks. What needs to be reviewed will depend on the type of property again, the location, and the circumstances of the purchase, but there are a number of common areas that buyers should be familiar with. One of those is having the contract reviewed by a solicitor or conveyancer. They can review the terms and contract, identify any unusual conditions, and explain the buyer's legal obligations before the contract is signed. This gives the buyer a clearer understanding of what they are agreeing to before the contracts become binding. A building and pest inspection can also provide useful information about the condition of the property. For example, an inspection might identify structural issues, water damage, termite activity, or other defects that may not be obvious during a normal inspection. The purpose is to better understand the condition of the property before making a final decision. For apartments, townhouses, and other strata properties, the strata records may also be worth reviewing. These records can provide information about the strata levies, the financial position of the owner's corporation, plant works, disputes, and previous building issues. This can provide a broader picture of the property beyond the individual unit or townhouse. Buyers may also want to understand whether there are any location or property related risks that could affect the insurance. Now, depending on the area, this could include things such as flood risk, bushfire exposure, or other hazards. These factors can affect the property itself and, in some cases, the availability or cost of insurance. It's also worth remembering that the lender assesses the property as well as the borrower. The property generally needs to meet the lender's requirements as an acceptable security for the loan. Certain property types, locations, sizes, or characteristics may be treated differently by different lenders. So, a property being within the buyer's price range does not automatically mean every lender will accept it. Auctions are a little bit different because the timing is much tighter. Now, in many cases, once the successful bid is accepted, the purchaser is unconditional. That means the contract review and other due diligence generally need to be completed before bidding. A buyer should understand the contract, the property, and the finance position before entering the auction. The key takeaway is that due diligence may involve some upfront cost and effort, but it can help uncover issues before the buyer is committed. The goal again is to understand the property, understand the contract, and understand any risk before making the final decision to proceed. When it comes time to make an offer, the price is only one part of the discussion. An offer can also include different terms and conditions, and those details can influence how attractive the offer is to the seller. So it does help to understand the full structure of the offer, not just the dollar amount. The first part is the obvious one, the price that is being offered, but the terms can matter as well. For example, a seller may have preferences around timing, conditions, and how quickly the transaction can move forward. That means two offers at the same price may not necessarily be viewed in the same way. Depending on how the offer is structured, there may also be conditions relating to finance, building and pest inspections, or other due diligence. These conditions can give the buyer time to complete certain checks before the contract becomes unconditional. The exact wording and effect of those conditions should be understood before agreeing to them. The deposit and settlement period can also form part of the negotiation. For example, one seller may prefer a shorter settlement, while another may want more time before moving out. So sometimes the timing of the transaction can be just as relevant as the price itself. Before negotiating, it can help to decide on a maximum price in advance. Now, this is often referred to as the walkaway number. The purpose is really just to set a limit while the decision is still relatively objective, because once negotiations become competitive or emotional, it can be very easy to keep increasing an offer simply because someone else is still bidding. Auctions work slightly differently from a normal private treaty. In New South Wales, there are no cooling off period when a property is purchased at auction. That means if you are the successful bidder, you are generally committed to the purchase once the auction concludes. Because of that, buyers should have the finance position, contract review, and other relevant checks considered before you bid. A good approach is to go into the negotiation knowing your limits before the pressure starts. Try not to increase your offer simply because the other side is pushing for more or because another buyer may be competing. Know what the property is worth to you, know your maximum price, and be prepared to walk away if the numbers no longer make sense. Once an offer is accepted, the process moves towards completing the purchase. There are still several steps between the exchange and receiving the keys. Contract exchange is where the buyer and seller enter into the contract. The terms and conditions should be understood before the buyer becomes legally committed. At exchange, the required deposit is generally paid. This forms part of the purchase price, with the balance due at settlement. If finance is being used, the lender may still need to complete a valuation and any final checks. Once the remaining conditions are satisfied, formal loan approval can be issued. After formal approval, the lender will generally issue the loan documents. These need to be completed and returned so the loan can be prepared for settlement. Before settlement, insurance may need to be arranged and the buyer will usually complete a final inspection. This is the final opportunity to check the property before the purchase is complete. At settlement, the remaining funds are transferred and ownership passes to the buyer. Once settlement is complete, the buyer can generally collect the keys and take possession of the property. Formal approval is a major milestone, but settlement is when the purchase is actually completed. So once settlement takes place, the property officially becomes the buyer's. Settlement is a huge milestone, especially when you're buying your first home, but there are still a few things you should check once the loan has actually settled. The first 30 days after settlement are really about making sure everything has been set up the way you expected. There are 6 things I'd suggest checking. First, log into your internet banking and confirm that your loan balances, your repayment amount, and importantly, when the first repayment is actually due. Second, if your loan includes an offset account, make sure the account is open and that it has been correctly linked to the right loan. Third, make sure your direct debits are set up and that you have full access to your online banking. You don't want to discover on the day that the repayment is due that something hasn't been connected properly. Confirm that your insurance arrangements are in place and keep copies of your important loan and property documents somewhere secure. Now, this is the time when you start rebuilding your cash buffer. Buying a home can use up a significant amount of your available cash through the deposit, stamp duty, and other settlement costs. So once you've moved in, rebuilding that emergency reserve should become a priority. And finally, schedule regular reviews on the loan. Your interest rate, your property value, your income, and even your long-term goals can change all the time. So the loan that was suitable for you on settlement day shouldn't simply be forgotten about the next 20 or 30 years. And this is another important reminder, a good broking relationship doesn't end on the day of settlement. For us, settlement is really the beginning of the longer term relationship. We want to make sure the loan remains appropriate, help you understand your options as circumstances change, and be there when you're ready for whatever comes next. Let's look at a simple example. Assume you're buying a property for $650,000. We will compare a 5% deposit with a 20% deposit. With a 5% deposit, you will contribute $32,500. Allowing $4,000 for legal costs and incidentals, the minimum cash required is $36,500. Now, that would leave us with a loan amount of $617,500. At 6.25% per annum over 30 years, principal and interest repayments, that would be approximately $3,802 per month. With a 20% deposit, you would contribute $130,000, including the same $4,000 for legal costs and incidentals. The minimum cash that is required is $134,000. Now that would leave us with a loan amount of $520,000. At the same rate and the loan term, the repayments would be approximately $3,202 per month. So the key difference is straightforward. The 5% option requires much less cash upfront, but it leaves you with a larger loan and higher repayments. The 20% option requires substantially more cash upfront, but reduces both the loan amount and the monthly repayment. So the deposit is only part of the cash required. You also need to allow for the other cost of purchasing. Let's look at how a family guarantee can work in practice. Assume the buyer wants to purchase a property for $650,000. Instead of providing a large deposit, a family member agrees to support part of the loan using equity in their own property. That can reduce the amount of cash the buyer needs upfront, but the buyer is still responsible for the full loan amount. The important part is that the family member is not necessarily guaranteeing the entire $650,000 loan. The guarantee instead is limited to an agreed amount and is supported by the family member's property. Now, in this example, the buyer borrows $650,000, which represents 100% of the purchase price. Again, the buyer would still need to cash for cost of purchasing, such as the $4,000 that we have now put in place for legal costs and incidentals. On a $650,000 loan at 6.25% per annum over 30 years, with principal and interest repayments, that would be approximately $4,002 per month. Now, because the family member is putting their own property at risk, they should obtain independent legal advice before entering into the guarantee. There should also be a clear plan for how the guarantee can be released in the future. So a family guarantee can help someone buy sooner without having to save a large deposit, but it doesn't reduce the size of the buyer's loan. The buyer will still be responsible for the full debt and the repayments. Let's look at a different decision first home buyers often face. Do you buy a more affordable property sooner or wait longer and save for the property that you really want? There isn't always one right answer. You need to compare the cash that is required, the repayments, and the cost of waiting. Now, under option A, the buyer purchases $550,000 property with a 10% deposit. That means a deposit of $55,000. Allowing for at least $4,000 for legal costs and incidentals, the minimum cash that is required is $59,000. Now, the loan before any lender's mortgage insurance will be $495,000. At 6.25%, the repayment would be approximately $3,048 per month. Under option B, the buyer waits and purchases a $650,000 property with a 20% deposit. The deposit would be $130,000, including the same $4,000 for legal costs and incidentals. The minimum cash that is required is $134,000. The loan would be $520,000 with repayments of approximately $3,202 per month. So in this example, waiting requires at least $75,000 more cash up front, but the difference in monthly repayments is only $154. That doesn't automatically mean buying sooner is better. You also need to consider the rent you may pay while you're waiting, whether the cheaper property actually suits your needs, and how much flexibility each option gives you in the future. Let's finish with the 5 key takeaways. First, start with your goal. Be clear on what you want to buy, where you want to live, and what matters most to you. Second, know your numbers. Understand how much you can borrow, how much cash you need, and what level of repayment you're comfortable with. Third, choose the pathway that fits your situation. Now, that may be a smaller deposit, a government scheme, a family guarantee, or taking more time to save. Fourth, build your team early. Having the right broker, conveyancer or solicitor, and other professionals involved early can make the process much smoother. And fifth, follow the process in the right order. Get clear on your finance position first, understand your limits, and then make decisions on the property. If you're still unsure about your borrowing capacity, deposit options, or what your next step should be, book a first home buyer strategy conversation with Advantage Lending Group. We can look at your position, explain your options, and help you work out a clear plan before you buy. And that brings us to the end of the First Home Buyer Masterclass. Thank you for taking the time to watch. I hope this has given you a clearer understanding of the home buying process, how the finance fits together, and some of the things to think about before making your first purchase. If there's one idea I would like you to take away from this, it is to understand your own position before committing to a property. Know how much you can comfortably afford, understand the cash that you'll need, and make sure the loan and the property still makes sense for you after settlement. If you would like to take the next step and work through your own circumstances, you're more than welcome to book a first home buyer strategy conversation. We can look at your borrowing position, the cash that you have available, the different pathways that may be suitable, and what your next steps could look like from there. Our contact details are on the screen, so feel free to get in touch when you're ready. Thanks again for watching. Buying your first home is a big milestone, so take your time, understand the numbers, and make decisions that are right for your circumstances. From all of us at Advantage Lending Group, we wish you all the very best with your first home purchase.